The American housing market is teetering on the edge of what could be the most significant downturn since 2008, with builders across the nation holding an astronomical inventory of nearly 500,000 unsold homes, a number that surpasses even the dangerous levels seen before the last major housing crash. In a desperate move that signals deep market distress, major home builders are slashing prices by up to $50,000 per home and offering unprecedented mortgage rate buydowns to 4.5%, financial concessions that even industry veterans say they've never seen before in their careers. Today, we're going to dive deep into the data that's causing housing market experts to sound the alarm about what's unfolding in real time. The numbers we're seeing aren't just concerning, they're potentially catastrophic for certain regional markets. We're going to break this down in a way that shows you exactly why this situation is so serious. Currently, home builders are sitting on an inventory of 492,000 unsold homes as we close out 2024. To truly understand the gravity of this number, we need to put it into historical context. This represents the second highest level of builder inventory ever recorded in American housing market history. The only time we've seen inventory levels approach this magnitude was during 2006-2007, mere months before the housing market experienced its most devastating downturn in modern history. But here's what makes today's situation potentially more dangerous than 2008. Back then, the inventory buildup was gradual, giving the market time to adjust. What we're seeing now is a rapid acceleration of inventory accumulation, particularly in the last 6 months of 2024. This speed of accumulation suggests that builders have seriously misjudged market demand, leading to what could be a much more sudden and severe price correction. The situation in the southern United States deserves special attention because it's here that we're seeing the most alarming trends. This region alone is currently grappling with over 300,000 homes for sale, the highest level ever recorded. Think about that for a moment. We're not just seeing high numbers, we're seeing unprecedented levels of inventory that surpass even the 2008 crisis. This concentration of inventory in one region creates a unique risk factor that wasn't present in the last housing crisis. Now, let's examine what the nation's largest builders are telling us through their recent financial reports, because their data provides crucial insights into where the market is headed. Lennar, America's second largest home builder, has just reported a staggering 9% year-over-year decline in revenue. Their stock hasn't just dipped, it's plummeted 25% in just 3 months. This isn't a minor correction, it's a significant market response to deteriorating conditions. What's particularly telling is the language being used by builder executives in their earnings calls. Stuart Miller, Lennar's CEO, recently stated that the housing market that appeared to be improving as the Fed cut short-term rates proved to be far more challenging as mortgage rates rose almost 100 basis points. That's not just corporate speak, it's a clear admission that even the industry's leaders were caught off guard by the market's rapid deterioration. DR Horton, the largest home builder in America, is facing similar challenges. Their recent earnings report revealed a 5% year-over-year revenue decline, missing fourth quarter estimates. But what's more concerning is their forward guidance. When their CEO Donald L. states that rate volatility and uncertainty are causing homebuyers to stay on the sidelines, he's not just making a casual observation, he's signaling a fundamental problem in market demand that could persist well into 2025. Let's dive into what we consider the most crucial aspect of this developing crisis, the regional concentration in the southern states. This curved region, stretching from the Carolinas through Texas and up to California, is showing the most severe signs of market stress, and understanding why this matters is key to predicting where the market is headed. Let's break down the numbers state by state, because this shows us exactly where the pressure points are building. Texas now has 115,000 homes for sale on the resale market, the highest in 7 years. But it's not just the numbers that's concerning, it's the rate of increase. In just the last 6 months, inventory levels in Texas have jumped by 35%, indicating a rapidly deteriorating market situation. Florida's situation is even more dramatic, with 152,000 homes available, also a 7-year high. What makes Florida particularly vulnerable is the concentration of new construction in areas that are heavily dependent on out-of-state buyers. As interest rates have risen and the overall economy has shown signs of weakness, these buyers are becoming increasingly scarce. In one development in Tampa, builders are offering 5-bedroom, 3-bathroom homes at 2,500 square feet for just $369,000. That's only $150 per square foot, prices we haven't seen in years. But here's what's truly unprecedented. They're offering mortgage rates as low as 4.7% for the full 30-year term. Resellers can't compete with this. The aggressive pricing strategies we're seeing aren't just desperate moves by builders. They're creating a dangerous dynamic that could trigger a broader market collapse. Let me explain exactly how this works using a real example from the Tampa market. Consider this scenario we encountered. A homeowner who bought from a builder 2 years ago for $317,000 is now trying to sell for $395,000. However, they're competing directly against the same builder who's offering newer, bigger homes at lower prices with better financing terms. This creates what we call a death spiral in home values. As builders cut prices to move inventory, they force existing homeowners to cut their prices even more deeply, creating a cascade effect that can rapidly devalue entire neighborhoods. But the price cuts are just one part of the equation. The mortgage rate buydowns we're seeing are particularly concerning because they suggest builders are willing to sacrifice their profit margins to move inventory. When a builder offers a 4.7% mortgage rate in a market where conventional rates are over 6%, they're essentially buying down that rate at a cost of thousands of dollars per home. This level of financial concession is simply unsustainable. Please take 2 seconds to help us out and hit the like and subscribe if you find this video interesting so far. Each like and subscribe helps support this channel and keeps us motivated to keep making you great content. Thank you. Now, let's continue. Looking ahead to 2025, several key factors suggest this situation could worsen before it improves. Companies like Meritage Homes, the 7th largest builder in America, have announced plans to increase their spec inventory in 2025 despite current market challenges. This decision appears to be based on optimistic projections that may not align with market realities. The most concerning aspect of these projections is the disconnect between builder plans and market fundamentals. While builders are planning to increase production, we're seeing clear signs of weakening demand. Mortgage applications are down, cancellation rates are up, and affordability metrics remain at historically challenging levels. Now, here's the truly mind-blowing part of this story. We're experiencing the worst housing affordability in history, and builders are still ramping up production. Mortgage purchase applications have cratered to 43% below 2019 levels. Even after rates dropping significantly from 7.8% to 6.1%, buyers aren't returning to the market. The typical California home now costs an astounding $800,000. Mortgage payments are at historic highs relative to income, and builder confidence is dropping despite lower rates. This disconnect between builder activity and market reality is eerily similar to what we saw in 2008. Let me show you something even more disturbing. Multiple builder communities in Tampa look exactly like 2008. At one DR Horton site, remember, this is America's largest home builder, there is an entire street of brand new homes, every single one of them with an available sign. No cars in the driveways, no families moving in, just empty houses sitting there, waiting for buyers who aren't showing up. And here's what should terrify current homeowners: the massive pipelines of homes still coming. At one building site, they're still putting stakes in the ground, marking out lots for even more homes. The builders are literally ignoring all the warning signs and plowing ahead with more construction. But the real shocker? Let me show you what's happening with home values. Take this mansion outside Dallas. 5 bedrooms, 5 bathrooms, originally listed at $899,000 in June. Today, down to $775,000. That's a $125,000 price cut in just 4 months. The Zillow estimate on this home has now dropped back to late 2021 levels. And it's not just luxury homes. Look at this 3-bed, 2-bath in Lakeland, Florida. The owner bought it for $254,000 in March 2023. Now it's listed at $230,000. They're taking a 10% loss in less than 2 years. And it's been sitting on the market for 256 days. Think about that. Nearly 9 months without a buyer, even with significant price cuts. For investors and potential home buyers, this creates both risks and opportunities that need to be carefully evaluated. In certain markets, particularly in the Sunbelt states, we could see price corrections of up to 10% in 2025. However, this doesn't mean every market will be affected equally. Some areas, particularly those with limited new construction and strong local economies, may remain relatively stable. Given everything we've covered, here's what you need to do if you're considering buying or investing in real estate in 2025. First, focus on understanding your local market's specific dynamics rather than national trends. This means tracking inventory levels, monitoring price movements, and paying close attention to builder activity in your target areas. Second, if you're considering buying in an area with high builder inventory, you need to think very carefully about the long-term implications. While attractive prices and financing terms might be available now, the potential for continued price pressure needs to be factored into your decision. This is particularly true in the Smile states, where inventory levels suggest potential price corrections in the coming year. As we continue to monitor these market developments, we want to hear from you. What are you seeing in your local market? Are builders offering similar incentives in your area? Share your observations in the comments below, and don't forget to subscribe for more real estate market analysis. Remember, while we're seeing concerning parallels to 2008, this situation is unique. Stay informed, stay analytical, and make decisions based on data rather than emotion. We'll be following these developments closely and bringing you regular updates as the situation evolves. We'll see you next time, and make sure to watch this video as well.